Welcome to Multifamily Insights. I'm your host, John Casman, and I want to thank you for joining us for another great episode. Now, if you're enjoying this show, do me a favor and leave us that rating and review. I'd love to hear from you and learn how we can make this show work harder for your investing goals. And if you have not done so already, hit that subscribe button so you don't miss an episode. All right. Today, we got a great show. We're going to be talking to Andrew Cushman. Andrew Cushman is a former chemical engineer who found his entrepreneurial calling in real estate. Now, in 2007, Andrew left his corporate position to start a business in real estate investment, starting with flipping single-family properties in Southern California, and then ultimately moving into multifamily acquisitions in 2011. Up to date, he has syndicated and repositioned over 2,300 multifamily units. Let's welcome to the show, Andrew Cushman.
Yeah, thanks, John. Good to be here.
Absolutely, Andrew. It's great to have you on the show. I have heard your name and seen you on many different podcasts and have been able to check out some of those episodes. But for those listeners who are not as familiar with you, why don't you take 2 minutes and go over your background in a little more detail?
Yeah, you touched on some of it. When I was in high school, I knew I wanted to have my own business, but I didn't know what looked like or how that worked. So I just figured, hey, if I get a chemical engineering degree, I'll always have a good job and a decent income. So I did that, graduated college, started working as an engineer, got married, and my wife kind of had the same mentality of like, yeah, it'd be cool to be able to do our own thing. So we tried all kinds of different different types of little businesses. And then finally we discovered flipping houses. And we did our first one in 2007. I basically made as much as I made all year at my engineering job. So I said, that's it. I'm out. Went and quit my job as an engineer, went into flipping full time. 2 years later, my wife quit her job. And then after about 4 years, we said, all right, 2009, 2010, they were great. We did really well, but this is a lot of work. It's just another brutal job, really, when it comes down to it. And so we said, what builds more lasting wealth? And then also, it's been a great time to flip, but word is out. Everyone else is trying to do it now. Prices have bottomed. There's not as much equity. What's the next big cycle? What's the next big thing? And we figured, well, we just had a huge recession, which means we're probably going to have a big, long expansion. So that probably means, job creation, household formation, rising incomes, all of that. And then we also reasoned that, okay, well, half the country just got foreclosed on. And so basically everyone can't buy a house for 7 or 10 years. And then everyone else is too scared to buy a house for the next 7 or 10 years. So that probably means if you put all those things together, rentals are going to be a really good place to be. How do you scale rentals? Apartments. So I went and found a guy who had already done about 800 units, hired him as a mentor, kind of hold our hand for the first year. Our first deal was 92 mostly vacant units on the other side of the country out in Macon, Georgia. I don't recommend going to that kind of property for your first deal. But it worked out well, and a decade and a few thousand units later, it's been a fantastic business, and we've been fortunate to do well and really enjoy it. So
I love it, man. Andrew, you talked about really going back to your high school days. You knew you wanted to be an entrepreneur, but like many people, didn't know exactly how to take that vision and bring it to life. So instead, you got the reliable degree as a chemical engineer, worked that job, discovered flipping, major salary on one deal, said, kudos, I'm out. I will take this and do this full time now. Your wife ended up doing the same thing, and then you transition into multifamily, realizing a lot of the metrics that we talk about when it comes to looking at the demographics, right? You mentioned job creation. You talked about rental demand. You talked about, income growth, but also recognizing that many of the people who wanted to buy a home couldn't based on what was happening with the economy. And people who could buy a home didn't want to because they were just scared. So the demand for apartments really grew. And you talked about hiring that mentor, buying 92 units in the other side of the country, or on the other side of the country, out in Macon, Georgia, most of them vacant, but using that to really spring forward into this larger portfolio that you have today. I want to start really with the transition from single family flipping into multifamily, because many people, they see that. And I thought what was really interesting is you realize that while real estate allowed you to escape your 9 to 5 job as a chemical engineer, it was really just buying another job on the flipping side. Yes, you were
Mm-hmm.
making money, but you were still having to work. You weren't getting the equity. You had to sell the property to actually get the money. And maybe there was even more risk involved. And that kind of got you into multifamily. Let's just start there because I think there are a lot of people who, right now, as we're talking about this, maybe are making good money in single family, maybe doing some flips, maybe other kind of projects. And they look at multifamily and maybe they see it as a little too risky, or these deals are too big for me to get into. What would you say to someone who maybe is currently flipping or buying single family rentals? What would you say to them about scaling into multifamily?
Yeah, well, I'd say number one, risk is really comes down to lack of knowledge or control, right? So there, that one of many ways to mitigate and lower risk is to educate and educate yourself and learn more about whatever you're doing. In terms of flipping, and also I definitely don't want to shade flipping because number one, that got me started, got me out of my job. And then two, there are guys out there, guys and gals, who have figured out how to turn flipping into a 7-figure business, put people in place, and then they step back and they're not really involved, right? I wasn't that good at that. So what I had to move to multifamily, which naturally is much lends itself to scaling much more, naturally than having to put all those pieces into place.
Can you explain a little more? Because I think that's something that, again, you're a chemical engineer. You come from professional corporate America, and I come from corporate America too, right? I was in advertising and marketing. And what I have found personally is that when it comes to flipping and really that blue collar esque nature of being in construction and being on site and
Mm-hmm.
managing that process every day, my skill set was actually not very good for that. And I felt it was better suited for multifamily. But just elaborate a little bit more, because I think people see this and they hear people talk and it just seems so easy to just go out there, hire a contractor, get a crew and make it happen. But maybe you can elaborate a little more.
Yeah, I'd say multifamily in many cases is actually easier, right? So think about let's take 4 separate houses versus a fourplex, right? So small multifamily. What is easier to manage and renovate? 4 houses scattered around different parts of the city, or 4 units that are part of one building in one location, right? You have one roof instead of 4 roofs. You have one yard instead of 4 yards. You have one location to manage contractors are at instead of 4 separate spots. And so, the management of that multifamily, both in the short and the long term, is much easier when it's 4 units in this case, one building versus 4 units scattered around. That's those efficiencies of scale get better and better the larger you get, right? So when you get to, let's say, 100 units, what happens is that is actually, it is far easier to buy 100 units than it is to buy 10. And the reason is because it's the same amount of work. You still have to do the same amount of legal work. You still have to do the same survey, the same environmental, the acquisition. It's all the same. It's a little takes a little bit more money, obviously, but other than that, the steps that you take are the same. However, when you get into 100 unit size property, once you close, you hire a manager, you hire a maintenance person. That is their full-time job to run that. And so the bigger you get with multifamily, the easier it gets especially in terms of management and also cost efficiencies. When I think of, okay, would I want to own 100 units that are in, let's say, 12 buildings on one parcel of land, or 100 separate houses scattered all over Atlanta? Right? Like, which one of those sounds the easiest to manage? Not that you can't manage 100. I mean, there are people who do that, but in terms of easy and effective scaling, the multifamily is by far the best. And so part of why I say all that is don't be afraid of the big size. And you don't have to jump straight to 100 units. You can do, like the kind of what they call the stack method. You buy a fourplex, you take you use that to get yourself into then maybe 10 units, and then you can work your way up. Or you can go partner with somebody, go straight into the big deals. There's a lot of different ways to do it. But multifamily gets easier the bigger you get.
No, I love it. And thank you for clarifying that. And I think it's just really important for people, at least to open up their mindset, right? If you're listening to this, you're listening because you are interested in scaling a multifamily portfolio. And it feels counterintuitive to say the bigger the deal, the easier it is to do. But you're listening to Andrew and you've heard other people say similar things. And when you break it down, you can understand how you're mitigating risk by being in a larger deal. Let's talk about that 92 unit, right? So you mentioned that you hired a mentor who had over 800 units in her portfolio. Your first deal was a 92 unit, Macon, Georgia, halfway across the country, not mostly across the country. You're out there in Southern California. Just talking about that process. What, like, this was what, maybe 8, 9 years ago at this point. So, talk to me
11
about
years ago.
11 years ago. Okay. So talk to me about, just finding the deal, business plan. I mean, mostly vacant. So how did you get the confidence and everything to go out there and make sure this was a deal and be able to execute?
I was naive, and the broker saw a sucker coming from a mile away. Uh, uh, I mean, that is basically how and why I got that deal done, right? So, well, I mean, so I'll say that the things I did correctly and the mistakes I made on that. Number one, the thing I did correctly was I did not limit myself geographically speaking. Just because I live in California, I said, I love living here. I love to surf and ski and have, sunny weather 364 and a half days a year. However, it is not the kind of place I want to invest. It's not business friendly. It's not landlord friendly. You've got earthquakes. You've got legislative risk. There's all kinds of reasons that I would not want to invest here. But I can go to a place like Georgia or Florida or Texas where it is landlord friendly, it is business friendly, and I can get great returns on real estate. So that, I what I did correctly was not limit myself geographically speaking. What some of the mistakes that I made is, number one, as your first deal, whether it's, unless you already have a lot of experience with this type of thing, as your first deal, whether it's a 5 unit or a 10 unit or a 92 unit, generally speaking, don't go buy something that's highly distressed. This property was 75% vacant. The 25% of people who were living there were, paying cash with wads of 20s to the owner, whenever they could get around to it. So I mean, effectively, it was almost completely vacant. So we walk. When you do that, you walk into a negative cash flow situation day one, which means you're burning through reserves. Second, it was. It had like 15 years of deferred maintenance, which means, they hadn't repaired anything in a decade and a half. And it was built in the 60s and 70s. So it was just falling apart. So when you go to repair something like that, unless you've got lots of construction experience, you're probably not going to guess that repair numbers just correctly. And when you start trying to clean up a property like that, it's like peeling off the layers of a rotten onion. You take care of one layer, and then the one underneath is even worse. And so we underestimated the renovation budget. Also, what we didn't factor in was vandalism. When you have a mostly vacant property in a lower income area, and you start fixing things up, you got to be careful about people coming in and vandalizing. We had someone come in and rip the copper pipes out of the walls of a couple of units and cause $50,000 in damage. So, what I would do differently if I was starting out is, and let's say, someone's listening to this and they're like, okay, well, I live in San Francisco. I'm definitely not going to be buying here. What am I going to do? Go pick a market, and then find properties that have cash flow from day one, but still have some kind of upside to them. And not for your first deal, it's very tempting to go buy something that's in a bad area and highly distressed because it's cheap, right? Well, it's cheap for a reason. Don't get seduced by the fact that the price is low. So I would shoot for the middle, right? Don't go for luxury, super high price, but really, especially for your first deal, don't go for something that's the hardest to do. So I would, if I was looking to get started, pick a market, say this is the type of deal that I can comfortable with, or not, maybe stretches my comfort level a little bit. And you know what? When I buy this, I'm going to have cash flow from day one, so I'm not in the red. But if I do these other steps right, I'm going to add cash flow and I'm going to add value. So that's what I would do differently. I would still go buy out of state. I would still go for the biggest deal I could, right off the bat because I said, again, it's easier, it's more fit, you get better financing, everything. But I wouldn't go for a really hard deal. I would go for one that cash flows and then has upside. So
What about your team on the ground? Did you already have a PM established, or who kind of do you work with to, not names, but did you already have kind of partners, or do you hire a third party management team, or what was your process there?
So the process for the first one for me on that one was the property manager at that property was actually great, but the seller wouldn't let her do or spend any money, do anything or spend any money. So her hands were tied. So we kind of could tell, and we gave her a chance and kept her on, and she actually did a fantastic job turning that place around. And the benefit was is she knew and lived that submarket. She knew the people, she knew how everything worked. I mean, so she ended up being really great. So that, and then we also had the same experience with a maintenance person. So we were very fortunate to bring on-site staff. In terms of overall property management, my mentor had a property management company because then he had his own portfolio and he basically kind of built his own property management company. And so I had him come in and manage for 2 years. After about 2 years, we decided, he kind of decided to get out of property management. And so what I did, and this is exactly what I would do, number one, if I was getting started today or if I was going to a new market today. So what we did is knowing that I was looking for a management company, every broker I talked to, let's say a broker sent me a deal or whatever, I'd say, hey, if you were buying this property, who would you hire to manage it for you? And I wrote down the responses. I did that with every broker I talked to, and I built a huge list. And sure enough, the same names would keep coming up over and over and over again. And so the management companies that came up over and over again, I built a list. I think it was like somewhere between 7 and 10 of them, right? My wife went and researched them all online, and that eliminated about half of them. Then I did phone interviews with 4 or 5, and then I flew out to Atlanta and met with the last couple and then picked one. That process worked well enough that a decade later, they not only do they still manage our stuff, we've given them all of our stuff. All right. And so that's the exact thing I would do if I was brand new starting out. Or like I said, if I'm going to say, you know what, we're going to go buy in Dallas, I would go through that exact same process. And because I said and nothing's perfect, but that's going to give you the highest odds of hiring the management and putting that piece of your team in place that's going to be the best fit for you and your asset.
I love it, man. Listen, you gave a lot of value in the last few minutes here. So I want to unpack some of it to make sure everyone's capturing the insights you just laid out. So going back to it, we talked about, it's kind of ironic because we talked about, oh, go big, scale, it's less risk. And the first thing we talk about is, this 92 unit, mostly vacant, all the mistakes that were made. But here's the thing. There are a lot of things that you did right. And, one, the first thing I have here is you hired a mentor. Understanding this was a new venture, that you're now in commercial real estate, the stakes are a little bit bigger. Do not assume you can just go out there and do it by yourself, right? You're going to make mistakes, but you want people in your corner that have more experience that can help guide you through the process, so you can mitigate those risks and manage what mistakes you actually do make. So hiring that mentor or having someone who is more experienced in your team is a definitely great thing that you should do. Second thing was expanded markets. You're in Southern California. Don't restrict yourself to your backyard. Look across the country. Look at landlord-friendly markets. Look at places that are growing in population, growing with diverse economies. Look at places where people want to live, where it's easier to do business, more landlord-friendly, all of those things. And you found a place in Georgia that allowed you to grow there. The third thing that you did was you looked for deals that had upside potential. Now, in this case, you found a distressed property, and it was probably a little more distressed than you anticipated, but you found a property that you could create value and that gave you a bit of a cushion. Now, on the flip side, lessons learned, hey, maybe not find something that is so distressed or such a deep value add on your first deal, because you probably need to just lower the learning curve. So maybe look for something that is either cash flow positive today, or maybe it's 85, 90% occupied, where you can figure out how to fix, that last little bit of challenge and then make improvements to the property over time. You also talked about the amount of deferred maintenance that property had. 15 years of deferred maintenance. So if you're underwriting and maybe you're using a rule of thumb, maybe you're using 50% as the expense ratio. Well, if you've got a property that is 15 years of deferred maintenance, you're going to have a much higher expense ratio than 50%, because you're going to be spending a lot of money repairing plumbing issues, electric issue, maybe foundation, maybe, all sorts of issues, wall repairs, everything, right? So don't just go in there if you're looking at a deal and slap 50% in there and assume that that's going to work across the board. If you've got an older property with deferred maintenance, you got to expect higher capex or higher expenses. So that's a great insight that you need to take away is make sure your assumptions match what you actually see. Don't just take these models, plop in the numbers, and ooh, magically it works, go out there and do the deal. You have to really understand what's happening at that property and make sure your underwriting reflects that actual business case. So, Andrew, I think that's worth its weight in gold, just that nugget right there. But you gave a lot more. So let's keep going here. We talked about that. Then you talked about vandalism. As you are trying to reposition the community, recognize that some people won't like that. And some people are going to see an opportunity. If you're putting brand new stuff into a mostly vacant property, well, people will steal it. People will come in and take those copper pipes, or they will steal, that brand new refrigerator you put in, or whatever the case may be. So, how do you protect yourself? Maybe you install security cameras or other things like that to protect yourself so that you can manage this. So, again, thinking about vandalism and other things like that is a great tip, a great insight for anyone who is going through more of a heavy value add type of play. And then, lastly, these properties are cheap for a reason. Don't be allured by the return numbers. Recognize that there's more risk involved. And because of that risk, yes, you need to get a greater return, but they are cheap for a reason. So make sure you mitigate your own risk based on your experience level and the market that you're doing business in. So phenomenal insights right there. I really appreciate that. And that was just the first part. The second part, you just continue to slam home all these insights on selecting the right property manager. And I just think that's gold, right? You should write this down if you have not. If you're looking to build your team, particularly property managers, but really a team anywhere, especially if it's a new market, ask other people, who would you recommend? You asked every broker who they would use. They gave you a list of what ultimately became 7 to 10 property management companies. You then looked them up online, understood how they operate, cut that list in half, interviewed those individuals in person or on the phone, then in person, and you landed with a property management company that you're still doing business with 10 years later. And that's key because this is a relationship business, and finding the right vendor partners can make your life so much easier. If you can find the right partner to help you grow and scale, and they've got a way of looking at the business and giving you insights and understanding the market dynamics and helping you underwrite or project future rents, it's going to make your job much easier if you have the right people on the bus next to you. So excellent, excellent insights on how to do that to grow your business. Let's talk about where you're at today, right? So we've talked about where you started. 10 years later, you're still working with that property management company. We know you're around 2,300 units or so. Are all of your properties in the Georgia market? Are you in different markets? Talk to me about kind of the way you approach your business as a whole today.
Yeah, we had something like 800 units in Texas. Those are all sold and gone. We now focus on just the Southeast. So, yeah, which a lot of people include Texas in the Southeast. I'm like, it's in the dead center. It's not, it's the South, but it's not the Southeast. Anyway, so we focus on North Florida, Georgia, and the Carolinas. That the reason for that is that's areas where the number one driver for multifamily is supply and demand. And if you have population growth, that means you have strong demand. People are moving to those states. Incomes are going up, jobs are being created. So, and those states are, like I mentioned before, they're business friendly, they're landlord friendly. So we focus on those four states. Also, what we learned is, when we were doing Texas and Georgia and Florida, is there's value in focus and going, an inch wide and a mile deep instead of a mile wide and an inch deep. And what I mean by that is it got really hard to become experts in all the markets in Georgia and Florida and Dallas and Fort Worth and Houston, right? And we said, you know what, Texas is great. I actually spent 10 years living there. I love Texas. It was not, we decided to exit Texas, not because we don't think it's a great economic story or a great place to invest, but what we realized is there was much more value in, all right, we're going to become experts in the Florida Panhandle, in Atlanta, in Georgia, in South Carolina, and just go deep in knowing those markets and building relationships in those markets, because we just didn't have the bandwidth to do it in those areas, plus Texas, plus, whatever other markets. So that would be another thing I would say is if you're getting started, go through a process, pick a market, and then stick with it and focus on it. It's really easy, especially when you start getting on broker lists. Like I can't, in fact, it just happened this week where I got a property emailed to me that just looked great. And it's in Little Rock, Arkansas. All right. And, it's like, Yeah, but we don't do Little Rock. And even if I got a great deal, now I've got this property that's 1,000 miles from anything else I own, and it's just not so. Learn to say no. That's actually one of the biggest things to success is say no to almost everything, so that you can say yes to what's truly important. And so pick an area, pick a market, and say become an expert in that. Build the deep relationships, and and go deep. And that's part of why we're focused on just the Southeast. And then our target acquisition is B to A minus property that's between 100 and 250 units, in mostly secondary and tertiary markets in the Southeast.
Love it, man. Great insights right there. Pick a market, focus on it. You mentioned go an inch wide, a mile deep, as opposed to the other way around. That's a way for you to move quicker as well on markets. You've got your team,
Mm-hmm.
you have your market knowledge. You can move a little bit faster. You've got deeper relationships. So that is a great insight as well, for selecting market. Let me push back a little bit, right? Because I think the challenge and one of the reasons many people start looking at other markets is they're having a hard time finding a deal in the markets they're focusing on. So if you're out there, let's say you've been looking at your market for 6 months, you're underwriting deals, you're putting in offers, nothing's working. What do you do at that point? Do you then expand to markets, or is there something else you should do so you can go maybe that mile deeper?
Uh, you know, it depends on why you're not getting deals. And first and second of all, I would say we've gone 6 months plenty of times without doing a deal.
We've gone
And then
12 to 15. So
Yeah, as I say, actually, I think our longest run was 18 months. In the last 12 months, I think we've been continually under contract. I think we're 4 or 5 properties straight now, but yeah, we've gone 18 months without buying a deal, and 6 months stretch is not uncommon. And that's actually where the persistence and the focus pays off, right? Because especially if you're getting started, don't expect to see good deals until at least 6 to 12 months in, because you're going to call the broker for the first time. The broker has already got their preferred list of buyers that they go to dinner with, that they go to they kids soccer games with these people and all that. They have the relationships, and you're like, hey, I want to buy my first property in Dallas. They're going to, all right, add you to the email list. They're not going to send you the off market transaction that needs to close. They're not going to stake their reputation on you closing on it, right? So it takes time to build up those relationships to show that you're a legitimate player. So what you do is all those deals that you get that don't look that great, that's the purpose of those is not necessarily to get the deal, it's relationship building. So you analyze that deal, you call the broker back, and you say, hey, thanks for sending this. I took a look at it. Here's the reasons why it's not a good fit for me. Maybe the crime in the neighborhood is too high, or it's in a flood zone, or whatever specific legitimate reason. You say it's not a fit for you, and you keep doing that. It does a number of things. Number one, you're learning, because the best way to look to quickly spot a great deal is to look at 1,000 bad deals. Number two, you are just building that relationship with the broker or whoever's bringing you these deals. And then number three, you're training them to know exactly what you're looking for. So when they do have lunch with that owner 9 months down the road, and the guy's like, you know what, I've had this 10 unit property for the last 20 years. I'm thinking of just getting rid of it and retiring. That broker says, oh, you know what? I know the perfect guy for this. I'm going to call John, see if he wants to make you an offer. I might be able to get this taken care of for you. And then you get to see that deal and possibly buy it without it ever hitting the market, without it ever getting, 20 bids or anything like that. So it takes 6, 12 months, sometimes longer, to get to that point. And that's actually where it gets really difficult to not be like, this market's too hard, I'm going to go pick another one, right? If you pick the right one in the first place, then you shouldn't have to be, I'm just going to go to another market, right? Also, I would say, once you truly learn a market and get deep and efficient there, and maybe even have some people in place, then you can start adding markets. So it's not that you just pick a market and you're confined to it for life. That's definitely not the case. You just become an expert, become efficient, have all your team members, all your relationships in place, your systems in place. Then if you have the bandwidth to add another market on top of that, go for it. But just don't, especially if you're getting started, don't just keep hopping around. because you'll never get traction if you do that.
I love it, man. That's great insight because staying true to your process is so key. And just a quick example, we just sold a property, a 28 units, so smaller property we did a JV on, but it came exactly from what you described. I literally was going on like MLS and, finding those brokers, not the big, commercial brokers, but like those residential brokers who randomly would get, that one commercial deal every once in a while.
Those
And
are
I
gold.
searched right. And what I did is I found one on the market, I found the broker, and I just reached out to him and said, "Hey, do you got anything else? I see this one's under contract. Do you have anything else?" He's like, "No, we do a handful of these deals a year, but mostly we do 2 to 4 units, whatever." I'm like, "Well, if you get another one, please let me know." And I just kept following up with him. And about 4 or 5 months later, he said, "Hey, I've got a 28 unit. I'm sending it to 5 people who I think are interested. If I don't get an offer by Wednesday, I'm going to put this thing on MLS." That was
Mm-hmm.
like a Friday. I looked at it. I sent my sister. I was in another city. I sent my sister down there. She took a look at it, said, "Hey, it looks like what you told me it should look like." I'm like, "All right, great. That's all I needed, right? Just want to make sure what holes
Yep.
in the roof or whatever." And we put an offer that Monday, got under contract Tuesday, right? So we beat everyone to it. I just sold that property 2 days ago, right? And now, of course, I had a massive marketing on mine because I wanted to get the top dollar. But the point is that by staying true and diligent to that process, you can get those off market deals by building that relationship. So you just have to stay true, follow up, stay top of mind. It is absolutely key. One other thing I will share to the point Andrew was just making is um, one of the things you may want to look at if you are looking at deals and you're analyzing and you're not seeing anything, you also want to know, what's the volume of deals that get traded? Because if
Mm-hmm.
you're in a market that only has, let's say your criteria is, like yours, Andrew, 100 to 250 unit deals. Well, if you're in a market where only a handful of those deals actually trade each year, well, you may not have enough volume to actually analyze. And that was one of the mistakes I made early on is I was in such a tight market with such a tight criteria that I just didn't see enough deals. You go to, the first time I went to Texas on a deal and I drove and I was in San Antonio, I saw apartment buildings on like every corner. I'm like, this is why everybody's in Texas. Oh, okay.
Yeah.
I live in Cincinnati and I was from Chicago. We don't have that many 100+ unit apartment building complexes, right? So to get down to Texas and see them, I'm like, oh, okay. There's got to be inventory. So that's just one other thing I would ask you to look into is ask those brokers how many deals do they transact on a year. That'll give you a sense. If you're talking to the top 5 brokers and they're telling you they do 5 deals each or 10 deals each, and you start adding that up, okay, well, how many shots are you giving yourself? If there are only 50 deals that happen a year, it's going to be a little bit tighter for you to do something versus in a market where hundreds of deals get done. So, last little tidbit there. Andrew, I want to flip the gear. We've talked a lot about that newer investor and kind of that active investor who's looking to grow their portfolio and see more deals. Let's go to the other side. For that person who is more looking to invest passively, full-time job, busy professionals, looking to just put my money to work, as we think about where the market is headed, what should I be looking for in deals? How do I mitigate my risk going forward for the next 2, 3, 4, 5 years here?
Yeah. Avoid deals that are highly leveraged,
How do
meaning
you
70,
define highly leveraged? Yeah.
yeah, 75, 80, 85% leverage. Those are extremely popular in 2021. I think those are going to be coming to the market as, how should we say it, motivated sellers in 2023 and 24. Also, there's a very sneaky way of highly leveraging deals. I shouldn't say sneaky, but because it's not a nefarious or dishonest thing. But the reason I say sneaky is because I think most people don't realize what's happening. Is you'll see a lot of offerings come across with, they're getting a loan, and then there's a large, and most people are familiar with common equity, like, hey, I'm going to invest $100,000, I get shares or whatever, and I get depreciation, I get income, I get profit, etc. But there's a lot of deals that are done with, in addition to that, what's called a preferred equity piece, and that might be, let's say, you keep the number small. There's $1 million in equity. 300,000 is preferred equity, and the rest is common. So that 300,000, it's exactly what it says. It's preferred, meaning it gets preferential treatment above all the other investors, meaning it gets the cash flow first, it gets profits first, all that kind of stuff. And while it's not truly debt, it is another form of leverage if you are the limited partner equity or common equity behind it, right? So again, it's not wrong, it's not dishonest. Just be aware that if you're looking at a deal and it says the internal rate of return is 20.2%, which is pretty high these days, and you look at it, and you say, oh, well, 30% of the equity is preferred. That's why. Because what happens is that the preferred equity is often it gets the money first, but then it's capped, which means the common equity actually gets a lot of the upside at the end, which increases that IRR and can make it look attractive. But that's another kind of hidden form of leverage. So number one, just be really careful about deals that are highly leveraged. The second thing is be careful of any deal that has a bridge loan that has to be paid off in 2 or 3 years. Because there's a reasonable chance that the market may not be favorable to do that in only 2 or 3 year timeframes. Now, 5, 7, 10 years down the road, the fundamentals are so strong for real estate and especially for multifamily that we're absolutely looking for the right properties in the right markets that we believe in 5 to 7, 10 years down the road are going to be worth more than they are today, and then are going to perform well in the interim. But if you're looking to invest passively, make sure that the deal that you're investing in has debt attached to it that allows for basically the uncertainty that's in the market right now. There's an argument that rates will already be significantly lower in 2 to 3 years. That could happen, definitely. They could also still be high or higher than they are today. And none of us really knows. And so the way to hedge against that is to have debt that gives flexible exit strategies. So yes, if things are favorable, you can refinance 2 to 3 years from now, or even sell, but you don't have to, because that's where deals can get into trouble. Is if they have to refinance or sell and do it in a market where it's not going to work. And now they've got a problem. So you want deals that are not highly leveraged, and then you want deals that have flexible exit strategies. So worst case scenario, you can just hold, right? That's one of the most beautiful things about real estate is if you buy a stock and the company goes bankrupt, it's zero. Like you're done, right? With real estate, almost with rare exception, if you just hold it long enough, you will make a profit, right? It might not be what you were originally intending. It might not be a home run, but at least you're not losing money. And so you want to make sure any deal that you're investing in has that as a worst case scenario, right? Your worst case scenario is you're holding it longer, not you just lost your 100 grand.
I love those tips, man. One, be really excuse me. One, be really clear on the leverage. Understand pref equity and the way that's kind of used as another source of leverage on the deal. And just at least understand what you're looking at when it comes to those returns and understand where you fall in the capital stack. And then second, look at the bridge loans, pay close attention to any deal that needs to exit within 2 to 3 years. You really want to make sure you understand what's going on there. And the thing you said that I love is this notion of if you can hold a deal long enough, you're likely going to make money. And the way I like to think about it is the price of a property only matters on 2 days: the day you buy it and the day you sell it. You already know the day you're going to buy it.
Can I add a third day to that?
Yeah, please.
The day you refinance it.
The day you refinance, absolutely.
Just keep that one in mind.
Yep.
You're 100% spot on.
And that's it, right? The day you buy it, if you need to refinance it, the day you refinance it or the day you sell it. And the key is to control those latter 2 days. If you can control when you refinance and you can control when you sell it, then you're okay. If you have to resell it, or refinance it or sell it at a certain date, and now you're looking at the clock and you're trying to figure out what to do or where the market is and if it's going to rebound, that's where you can get into trouble. So if you can control those 2 exit days, that gives you a lot of the power. So just pay attention to that and make sure any deal you get into, the operators are paying attention to that and they kind of have a plan, a backup plan, a backup plan for how they're looking at the market. And if this, then that, and they're well positioned to navigate the uncertain landscape moving forward. But just great tips there for anyone looking to invest in these deals. Like you, I know you're a buyer right now. We're buyers as well. We're pretty bullish on the outcome of the market, but we do think you have to be, smart and continue to take mitigated risk and pay attention to the things that we just talked about there. Andrew, for folks who want to get in touch with you, they can check out your website, VPACQ, so VP Acquisitions, but VPACQ.com. And they can learn more about your company, some of the deals that you're doing, and check out and connect with you there. We're going to go to our round of insights. Are you ready?
Let's do it.
All right. Give me a failure or an apparent failure that sets you up for later success.
Yeah, one of our early deals. Well, actually, I mean, it's the one we can just say the one that we talked about. There's all kinds of struggles, and we did have a profitable exit on that because we recognized the place we were in the market, and we did get it turned around and all that. But like I said, we had multiple failures and we completely underestimated the renovation. We underestimated how difficult it was to manage a rough property in a rough area. And so what we did is we used that as the start of narrowing the parameters on what we would buy, right? Like, so today I would never buy anything like that. And part of the reason why is the lessons we learned from that deal and some others like it early on, where we realized, wow, there's a lot of headache and risk doing this that can be eliminated if we just change our parameters on what we buy, right? And so, those were, and then also same thing I talked about earlier about, we tried to cover too many dang markets in the beginning. We're in Texas, we're in Georgia, we're in Florida, and we ended up with deals in all those places. And again, they went just fine, and they were profitable, but we realized, this could be easier and more profitable if we focused. So I underestimated rehab, went for too much distress out of the beginning, tried to cover too much geographic area out of the beginning, and those are all, we learned from that and adjusted, and we don't do the super heavy distress. We narrowed our geographic focus, and some of the other stuff that we've talked about.
Give me a digital or mobile resource you recommend for your business.
Oh, there's quite a few. If you're looking for data for, looking at whether or not you want to buy in a certain market in terms of, is it in the flood zone, what's the median income, what's the population growth, Esri, ESRI. I think we pay $100 a year, and it's fantastic for all of that data. We use that for screening properties to say, are we even interested in this location?
Love it. Give me the book you've recommended or gifted the most in the last year.
Let's see here. The two that I recommend the most, and actually probably most apply actually to what we just talked about, is especially for newer investors or investors looking to make the jump from single family to multifamily, either if you're active or passive. Number one, David Green's Long Distance Real Estate Investing. It's written kind of with single family in mind, but the principles still apply the same to multifamily. That's number one. Number two is Brian Burke's The Hands-Off Investor. Now, if you're looking to be a passive investor, absolutely read that, because it basically tells you how to look at deals and truly analyze them, and based on what's being presented. But number two, if you're going to be an active investor, meaning you're buying deals, and especially if you're going to be raising money, read Brian's book so that you are prepared for what the smart investors or well-educated investors are going to be asking of you and looking for. So I would recommend that book to either passive or active. And then again, with David Green's, that book not only helps you get out of the mindset of I got to invest in my neighborhood, but it tells you how to go do that.
Love it. Great tips there. Give me a daily habit that helps you stay focused on your goals.
The last thing I do every night before shutting off my computer is sit down and make the plan for the next day. Right. So I have annual goals that are broken down into quarterly, that are broken down into, monthly and daily. And, on Saturday night, I actually kind of plan out the entire coming week. But then each night the last thing I do is sit down and plan out the next day, right? Because things change, things come up, meetings, whatever. And so that way, when I wake up the next morning, it's not like, okay, what am I going to do today? What's important? Oh, let me look at my 150 emails. Like, you can just ignore all of that because you already know what is first, and you already know what's most important. So that has been a incredibly helpful habit for me.
Give me your number one insight for multifamily investing.
Number one insight for multifamily investing. It's easier than you think it is, but not at the beginning. It's an unfair business, meaning it's hardest at the beginning, and the more you do it, the easier and easier it gets. So, it took me, I think it was 6 or 9 months just to get that first deal. And again, even that was because I didn't know what I was doing. I probably should have taken longer. It's persistence is key. Relentless persistence is key to really get going in this business.
All right, we'll lighten the mood a little bit here. You're based in Southern California. A lot of great options here, but give me your favorite place to grab a bite to eat.
You know what? It's really it's Cheesecake Factory. I can't do it too often because of the sugar load. But man, I'm telling you, they got. It's the toughest thing there is just deciding on. Of course, their menu is like 163 pages long, but there's a lot there that I love to eat. I guess second would be anything that I'm eating on the beach after surfing. So
there you go. I love it, man. I love it. Listen, I love the conversation today. Great insights, particularly going deep into the first deal. What you learned, mistakes you made. Just doing it though, and I think that's one thing I want everyone to take away is that. Yes, there are a lot of mistakes made, but you have to go ahead and take it. But also, there's an easier path for everyone, a path that you didn't have, a path that I didn't have, which is you can invest passively. Learn first as a passive investor and then transition to running your own deals as opposed to making these mistakes, by yourself on your own deal. But either way, take action. That's exactly what you did on that 92 unit, learning from that, revising your criteria, tightening up kind of your deal structure, and ultimately being able to build out this large portfolio now, working with other investors. For folks who want to learn more about you, the deals that you're doing, and learn more about how they can get involved, go to vpacq.com and you can learn more from Andrew and his team there. Andrew, just want to thank you again for coming on Multifamily Insights. It's been a great time talking to you, and I hope you have a great day.
You too, John. Take care.